Once again, time for the main event. My co-author and friend Greg Hess was supposed to do the introduction. Unfortunately, he could not come to this meeting today. So I'm going to have the pleasure to introduce Charlie. And of course, we go back, a long time. But I'm not going to go there. Instead, I'm going to start with Charlie's incredible SOMC connections, because Charlie Evans comes from a long line of Carnegie Mellon economists who have distinguished themselves in monetary economics, and several of them have contributed to the shadow over the year. Alan Meltzer was one of the founders. More recently, Marvin Goodfriend has been at Carnegie, and I'd say perhaps most importantly for Charlie's case, Ben McCallum, who was also Charlie's thesis advisor, and some of Ben is inevitably reflected in Charlie, even a few years later. Even though I'm sure there would be so many things where, if we hadn't discussion today, Charlie and Ben would probably disagree on some issues. So since 2007, Charlie has been the president and CEO of the Chicago Fed. But for people with my background, or Peter's background, being economists inside the system, what we find so incredible is to have someone like Charlie Evans, who built an impressive research record and became an expert on the Fed and on monetary policy and global model building, which inevitably made him a very influential voice once he joined the FOMC. But I have another anecdote I want to mention, which is when I took my European vacation in 2010. We had the pleasure of being on a panel together in Rome, and this was a conference that had been organized by Banca d'Italia and Banque de France at the time. We were on a panel on that day, October 1st, with the then governors of Banca d'Italia and Banque de France, Mario Draghi and Christian Noyer. And what I recall vividly, because all of us were surprised at an idea that Charlie was proposing at the time, which proved to be very important. And that was the idea that for the Fed to best fulfill its dual mandate, monetary policy had to be adjusted, and potentially much more accommodation would need to be added to the system. And the question was, how do you calibrate that, and how do you do that? And I recall that because, to me, that was the first shot, and when I became aware of the battle that was taking place in the FOMC, that Charlie eventually won when the FOMC decided to do the additional massive easing about 2 years later. And we can debate, in real time on which side of that argument we were. In October 2010, I actually thought that we didn't need to do more accommodation, as many others thought at the time that the global economy was coming out of the recession, and perhaps it would be time to start the normalization process. But I did not know on the 1st of October that by the end of the month, the French and German governments would decide to introduce credit risk in European sovereigns, which created the next phase of the crisis that the ECB still has not recovered from. And it's good to be open-minded and have the options to do the additional policy when needed. And in retrospect, I wish the ECB here more closely to what Charlie was talking about for the Fed. Even today, I could say that. So we're here today to hear Charlie's views about where we're headed next. And one of the things that I hope to get out of this talk is, for the Fed, the crisis is behind us, and the issue is to have an understanding about the tools that we can use and frameworks to think about the future, not the case for Europe or for the ECB, but this is the case for the Fed. And Charlie will give us his thinking on that.
Thank you. Thank you very much, Athanasios. Those are very generous comments, and I really appreciate that. It's a great pleasure to be here at the Shadow Open Market Committee meeting. As Athanasios mentioned, I do have a long memory of these meetings from being a graduate student at Carnegie Mellon and have the opportunity at least once a year to attend Carnegie Rochester conferences where Alan Meltzer and Carl Brunner would get together in the early days and hear about the Shadow Open Market Committee. So it's great to be here. I will admit something I probably shouldn't, that my speech is just a little bit longer than ideal. I'm glad that Athanasios introduced me because I've always wanted to take back a few of the minutes that he took from me on other panel sessions, and so I'm going to do that today. This committee is a distinguished and knowledgeable group that encourages public discourse on important issues related to monetary policy, and I hope to add to this morning's stimulating discussion with my prepared remarks. But let me say first that before I begin, let me remind you that my comments here today are my own. Most people don't have any trouble believing that, and do not necessarily reflect the views of the Federal Reserve System or the Federal Open Market Committee. I became president of the Federal Reserve Bank of Chicago in September 2007, just a few months before the business cycle peak. See, it was, I spend all this time trying to get my watch to do something, and I got to turn it on. The subsequent storyline is familiar to all of you. The National Bureau of Economic Research dated the beginning of the recession as December 2007. And by the fall of 2008, we were dealing with the largest financial crisis since the Great Depression. These difficult times required extraordinary monetary policy responses. The Fed established emergency lending facilities to support financial market functioning. Between September 2007 and December 2008, the FOMC cut the federal funds rate target from 5.25% to essentially zero. Thereafter, providing further accommodation required turning to non-conventional policy tools. Two important tools were large-scale purchases of Treasury and agency securities, which increased our balance sheet to $4.5 trillion, and forward guidance about how long we would maintain the funds rate at its effective lower bound. These policies were effective, and today the fundamentals for the U.S. economy are strong. By most assessments, the U.S. has achieved full employment. While the attainment of sustainable 2% inflation has taken longer, it now appears closer. Since December 2015, the FOMC has raised the federal funds rate to a range of 125 to 150 basis points, and the committee is in the process of a slow, steady renormalization of the balance sheet. If we are lucky, the future economic and financial climate will more closely resemble the pre-Great Recession experience, if not exactly a great moderation economy. Such a relatively benign environment, hopefully, would allow changes in the federal funds rate target alone to provide adequate monetary accommodation when needed without the use of other tools. But for a host of reasons, it is all too likely that policymakers will face more difficult monetary policy challenges when the next downturn occurs. So with the economy close to maximum employment and price stability, now is a good time to take a hard look at whether and how the Fed's monetary policy framework might be retooled to better deal with less favorable circumstances that inevitably will arise. Before I go further, let me state the three messages I want to develop this afternoon. First, most alternative monetary policy frameworks that have been discussed exhibit two pretty clear characteristics. During meaningful economic downturns, they likely will generate periods of aggressive monetary accommodation with short-term policy rates at the effective lower bound. And they also likely will require an extended period of inflation above 2%, and perhaps substantially so for some time. These features are and will be obvious to everyone in this room in the moment. And they beg the question, how will these policies be communicated to the public, and how will the public view these outcomes? Policymakers need to plan for this. Second, in selecting and designing any particular alternative framework, what will be the roles of financial competition and regulatory policies? And what will be the implications for market functioning? These alternative frameworks will likely feature long periods of low or negative real interest rates and the use of instruments such as large-scale asset purchases. How do we assess the interplay between the choice of monetary policy framework and the stance of financial regulatory oversight and supervision? Will these policies induce behavior that requires enhanced regulation in order to mitigate financial instability risks? Or, for each framework, are markets inherently self-equilibrating such that market discipline alone will be sufficient? The ultimate effectiveness of any strategy will depend on the answers to these questions. So policymakers will need to address the financial stability implications for each suggested alternative. Third, even if nothing much comes of these alternative framework discussions and no dramatic changes are made to our monetary policy framework, there are opportunities to improve our existing strategy. Namely, I think additional communication enhancements are needed to bolster the credibility that the FOMC will deliver on its policy mandates. We should concentrate more explicitly and more publicly on outcome-based policy settings aimed at delivering maximum employment and 2% inflation on average through the cycle. It is of great importance to strengthen the public's understanding of potential policy actions to better deliver symmetric 2% inflation expectations. We need to improve the public's understanding of our inflation objectives and reduce the percentage of the public that believes the FOMC's 2% objective is a ceiling. Better communicating such an outcome-based approach is a more useful enhancement for bolstering credibility than strict adherence to an instrument-based policy rules, the latter being a prescription that theoretical analysis often relies on to deliver monetary credibility. Of course, such an outcome-based emphasis would also be beneficial for executing any of the alternatives under consideration. To address these issues, I think context and historical perspective are critically important. I'm reminded of my time in Bennett McCallum's monetary economics class at Carnegie Mellon back in the 1980s. I distinctly remember Ben saying that much of economics comes down to two simple propositions. The first is that people do pretty well for themselves, and the second is there's no such thing as money illusion. Now, this is just a common sense way of saying that the public cares about real quantities, relative prices matter, and that because the public knows and lives by this, they can't be fooled repeatedly. Going back to Paul Volcker's time, the Federal Reserve's post-1978 monetary policy strategy has embodied these insights. This was formally stated in the Bernanke era as a long-run strategy for monetary policy, which was announced in January 2012. This strategy states that monetary policy is to pursue maximum employment, disciplined by an assessment of structural and sustainable labor market realities, and low and stable inflation, explicitly defined by a symmetric objective of 2% personal consumption expenditures price inflation. Any changes that might be made to our policy framework must be faithful to this overarching strategy of doing our best to satisfy our dual mandate objectives. Of course, the immediate impetus for thinking about alternative monetary policy frameworks is the policy costliness of the zero lower bound and the accompanying extraordinary monetary efforts taken during the Great Recession and its aftermath. Here I thought Larry Summers' comments at a recent Brookings-Hutchins conference framed the issue quite well. If we faced a steady-state neutral nominal policy rate of 5%, in most circumstances, we would have enough monetary capacity to deliver the accommodation necessary to react to downturns or to counter undesired disinflation. 500 basis points of easing ought to be enough to provide substantial financial support to the economy while avoiding the zero lower bound and maintaining an upward sloping yield curve with vibrant credit intermediation to facilitate the business needs of Main Street. However, today we live in a world where, for well-known reasons, the long-run equilibrium real federal funds rate might optimistically be 1%, but it may be lower. Adding our 2% inflation target to this real rate leaves the long-run nominal rate at 3% or perhaps lower. That falls well short of the 500 basis point buffer that the Federal Reserve policymakers have needed in the past. The Brookings-Hutchins Center Conference highlighted a number of alternative monetary policy frameworks that could provide additional accommodation and have been proposed. An explicitly higher inflation target, say 4%, is one of them. Nominal gross domestic product targeting, nominal GDP targeting, is another. Temporary or state contingent price level targeting is a third, and another one is unconditional price level targeting. Now, it's not my intention today to offer any endorsements or critiques of these proposals. As I emphasized previously, I'd like to highlight some of the important issues that will likely inform us about the strengths and weaknesses of the various frameworks and the things that they all have in common. Let me turn now more directly to the implications for inflation of these alternative frameworks. These frameworks often allow for a higher inflation rate, either permanently with a higher inflation target, or temporarily as policymakers close a price level or nominal GDP gap that opened up during protracted periods of below target performance. What would be the public's reaction to such higher inflation rates? To think about this, it's useful to consider the cost of inflation and the choice of an inflation target. Traditional monetary theory often focused on the shoe leather transaction costs associated with high steady-state inflation, notably those incurred in minimizing the costs of holding non-interest-bearing money. Later discussions included menu costs, relative price distortions arising from sticky prices, and interactions between the tax code and inflation. I would think such costs are lower today than, say, in the 1950s when Kagan wrote about money demand and provided foundations for assessing these costs. Interest-bearing transaction accounts, other financial innovations, e-commerce, and partial indexation of the tax code likely reduced these costs substantially. High inflation variability presents a different set of costs. A common argument for lower inflation objectives is that high average levels of inflation are associated with more variable inflation and that such variability generates real costs for the private sector. As Herbert Stein said in my undergraduate macro seminar back in 1978, the way a country like Israel at that time got to 60% inflation was not by starting out at 10% and increasing it by 10 percentage points each year. It instead followed an accelerating and volatile path with inflation going from 5 to 8, 15, 30, 60, and eventually above 400% by 1984. But that was after I graduated the University of Virginia in 1980. The risk of this type of out-of-control inflation acceleration and volatility is clear for dysfunctional monetary regimes, and it certainly is very costly. But I'm not aware of a theory that delivers such outcomes without the additional fuel of aberrant central banks pursuing objectives other than a stable inflation objective. For instance, if monetary policy were to be subjugated to supporting unsustainable fiscal conditions. Now, these are general concepts. What about a specific number for the inflation target? Many monetary economists start their thinking with the Friedman Rule, which says that to compensate for the opportunity cost of holding money, the optimal inflation rate is negative and equal in absolute value to the risk-free interest rate. Others have argued that 0 is the appropriate natural focal point. Alan Greenspan offered up another way to think about price stability. We should seek a rate low enough and stable enough that businesses and households won't factor inflation into their planning too much. One could argue that because in today's advanced economies, we see few resources, real resources expended to mitigate inflation costs, the Greenspan definition supports something around 2% for an inflation target. Central banks around the world have largely settled on 2% as an inflation target. I guess it's tempting to think that this consensus must mean that 2% is the right answer. I'm not going to go there. But it is useful to explain why 2% PC inflation might be the right answer, at least to justify why we chose it. When the Federal Reserve started discussing an explicit inflation target in the 1990s, it certainly recognized that many factors play a role in determining the best inflation objective. For example, there's the interplay between sticky wages and productivity. As highlighted by Akerlof, Dickens, and Perry, Downwardly rigid nominal wages can throw sand in the gears of labor markets and boost unemployment. The basis for trend nominal wage growth is the productivity trend plus long-run inflation, and long-run inflation should equal the inflation target. Accordingly, higher productivity growth, such as we experienced in the late 1990s and early 2000s, can support lower inflation objectives and maintain strong nominal wage trends. By strong, I mean that nominal wages grow by enough to support adequately flexible real wages without undue reliance on a large percentage of nominal wage cuts in order to equilibrate labor markets. So we would avoid nominal wage growth pileups at the 0% cutoff. Of course, another key consideration in the inflation target choice is how often our monetary policy framework might encounter the zero lower bound. Analyses done in the 1990s and early 2000s indicated that the odds were not large. For example, Reifschneider and Williams in 2000 estimated it at about 15%. But this calculation's changed. More recently, a 2017 Brookings paper by Kiley and Roberts found that given today's low productivity trends and a 2% inflation target, the probability of hitting the zero lower bound is closer to 40%. This represents a very high risk of experiencing a costly economic event that would require remedies policymakers have often found difficult, if not downright distasteful. Clearly, these zero lower bound odds would be less under a 3 or 4% inflation rate target. So a higher inflation objective should be included in any complete list of possible alternative frameworks. The other frameworks under consideration also would include potentially protracted periods of inflation above 2%. Closing an underrun of a price level target necessitates producing higher inflation for a time, and closing a big gap would require a big inflation episode. But how do we know such policies will be acceptable to the public? Here we have to return to the cost of inflation rates and variability that I just ran through. There are a lot of questions to ask, and I think that this discussion has to be done in order to make a decision. How big is the inflation tax and shoe leather costs at the relevant inflation rates? How much of other perceived inflation costs rests on aversion to nominal wage cuts or other issues regarding the differences between real and nominal variables? What's the state of labor mobility, and will unemployed out-of-labor workers, move easily enough to different regions of the country in order to equilibrate labor markets, or will they do that at all? With regard to pursuing a moderately higher inflation objective, is higher variability preordained, even if only temporarily, in the level targeting regimes? Or is our monetary policy making apparatus robust and credible enough to deliver low variability over a range of inflation objectives? Could the central bank successfully communicate the benefits of less protracted and shallower cyclical shortfalls in employment and economic activity that might accompany a higher inflation policy that avoids the zero lower bound? And if it could, how would the public weigh them against the perceived costs of higher inflation? The bottom line is that the acceptability of 2% versus a higher inflation objective, even temporarily, probably comes down to, first, how well various innovations and indexing have reduced the cost of inflation. Second, perceptions about real and nominal variables. And third, the ability of central banks to consistently implement policy so that inflation variability is relatively contained at different inflation targets. Let me now turn to the second point about interactions with financial markets and regulatory policies. Achieving our maximum employment and inflation mandates might require some long periods of strong monetary policy accommodation. Is the financial market system and regulatory environment robust enough to limit financial instability risks in such circumstances? Can the Fed conduct an effective and independent monetary policy strategy irrespective of the state of financial markets and regulatory policies? Financial stability is an important goal of the Federal Reserve. Indeed, the Fed was established to provide an elastic currency that supports credit intermediation. As we were all too aware during the crisis, a breakdown in financial intermediation can have severe consequences for the real economy. So we must ask if some alternative monetary policy frameworks might be more or less prone to generating financial instability risks. An important channel through which any accommodated monetary policy works is to increase incentives for prudent risk-taking, particularly with respect to fiscal capital investment opportunities. Lower for longer interest rates or policies aimed at reducing term premiums also incentivize financial risk-taking. But most economic models are silent on the regulatory parameters that could check excessive risk-taking should it take place. What should the FOMC do if our economic and financial stability objectives come into conflict? I'm in the camp that believes that monetary policy tools should focus on achieving our legislative mandates to support maximum employment and price stability. And I note that a healthy real economy generally supports financial stability. I believe remaining financial stability concerns are best met by well-structured macroprudential policies supported by vigilant micro-level supervisory and regulatory oversight. Accordingly, I see the state of financial regulation as important for assessing the effectiveness of these new alternatives. As I mentioned earlier, the proposed alternative frameworks have the potential for requiring protracted periods of accommodation, and if facing the zero lower bound, heavy use of non-traditional policy tools. If market discipline and our regulatory structures were too weak, and the financial system became too fragile during such actions, then the ability of monetary policy to achieve its dual mandate responsibilities would be harmed. In the extreme, if the actions needed to achieve, say, a price level target turned out to be impractical owing to financial fragility concerns, then the credibility of the price level target approach itself would be damaged from the outset. People would recognize that. So it's clear that the state of financial regulation must be taken into account whenever a particular monetary framework is being considered. A robust financial market culture in which excessive risk-taking is punished by market discipline first and regulatory restrictions next would allow for stronger and likely more effective monetary strategies to be pursued. But a weak, self-regulating market culture without adequate compensating public sector guardrails could perhaps preclude the otherwise most effective monetary framework strategies. Of course, given the spectrum of competing incentives, these financial regulatory challenges are quite difficult, and a robust macroprudential structure is relevant for any monetary policy structure, including our current one. But, and this is my point here, when designing strategies, we must understand the interactions between the monetary and regulatory frameworks, and we must recognize that these will change over time, both secularly and with the business cycle. I certainly acknowledge that we have much important work to do on this front. As I turn to the third and last issue, I want to reiterate that I'm not prejudging any alternative framework today. It's pretty clear as all I'm doing is asking questions. That being said, within the mix of possible alternatives, the Fed needs to give strong consideration to staying with our current monetary policy strategy. If we do so, we must ensure that it is as robust as possible. I believe an important way of achieving this is to emphasize outcome-based policies. Over the past several years, most of my monetary policy commentary has emphasized the need for policy setting aimed at achieving our maximum employment and price stability objectives more quickly and with more insurance against costly risk scenarios relative to many other policies, notably those generated by the well-known monetary policy rules. This is what I mean by focusing on outcome-based policies. I know that many react by saying this looks like time-inconsistent discretionary policy, and that the literature favors following policy rules. This brings me to the role of policymaker discretion versus adherence to strict policy rules in monetary policy strategy discussions. This topic is extremely relevant, whether we stick with our existing strategy or if we turn to a new one. For example, price level and nominal GDP level targeting provide relatively specific guidance on how monetary policy should evolve from period to period, if not FOMC meeting to FOMC meeting. The degree of discretion would likely be a good deal less than in the Fed's current balanced approach long-run policy strategy. How should we weigh this difference when assessing the policies? In such discussions, I think outcome-based policy action should take precedence over instrument-based decision rules. Changes in the economic environment may reduce the effectiveness of a strict instrument-setting rule, or at times even make it counterproductive. For instance, if we were to insist on a 2% intercept in a Taylor rule when we think the equilibrium real funds rate is really closer to zero, that's a problem. A policy focused on hitting mandated outcomes and risk management against adverse scenarios can avoid such missteps. By using informed discretion in instrument setting, a central bank can do a better job in delivering on its ultimate employment and inflation targets. Therefore, when judging one alternative against another, it's not a particular policy's adherence to an instrument decision rule that is important, but is instead its ability to deliver on the central bank's mandated policy goals. Here, I would also note that discretion and time inconsistency in an optimal control policy rule need not lead to undesirably high inflation. Of course, it does in the familiar benchmark for this topic, the Barrow-Gordon model. But this is because the model hardwires pursuing an unsustainably low level of unemployment and policymakers' preferences. The central bankers succumb to the lure of lower unemployment, they break the predetermined optimal plan, and voila, generate inflation. But by a similar argument, extreme distaste for inflation among conservative central bankers could lead to a downward bias in inflation. Ken Rogoff's conservative policymakers' preferences not only eschew unsustainably low unemployment, they create a policy strategy that on average generates below target inflation. In effect, the inflation target's no longer symmetric. It's more like a ceiling that the conservative central banker is loath to breach. Now, I don't want to be misread as saying that time consistency is unimportant. Rather, I feel in practice the issue is less about instrument setting and more about the need for policymakers to maintain a consistent, clear view of their long-run objectives and implement the best policies that will achieve these goals. Indeed, successfully communicating such a commitment in advance and demonstrating it strongly when the time comes would be key to establishing and maintaining the credibility of any new operating framework. The new framework must be seen as an innovative way to achieve the existing policy mandate and not as a simple change in the goalposts. In sum, I think that emphasizing outcome-based policies is key for our current policy framework and for evaluating any alternatives we consider. Critiques over time consistency, discretion, and bias in policymaker preferences all need to be judged against the strategy's ability to deliver on the central bank's mandated policy objectives. We must remember that not every theoretical impurity translates into a real-world stumbling block, and that the real world is not as straightforward as the simple economies we write down in our models. Thank you very much for your attention. I look forward to your questions and comments. That's a bit.
Thank you,
took
Charlie.
one extra minute.
Thank you, Charlie. This was wonderful, and you've confirmed that if Ben McCallum was with us, he would disagree on I think 4 items. So
Probably.
I'm not going to go to them.
I can believe that.
And Charlie has kindly accepted to take some questions. So I'm going to give everybody the opportunity as time allows. If you can start by stating your name, and I will just be pointing to people. Can start over there, and then we'll move over here.
Hi. Ooh, excuse me. Guy Hazelman. You and several of your FOMC colleagues have mentioned having a long period of time or a period of time where the inflation rate would rise above 2%. And certainly how you would communicate that and handle that is of interest. Certainly if you could raise your inflation target to 4%, but I think you would agree with financial valuations where they are, all else being equal, if you just announced that, we would all agree there would be a financial market instability that would defeat your whole purpose. So given that your forecast, the FOMC's forecast for inflation has undershot for years, given massive amounts of accommodation, should you now have inflation kind of above that 2.5% target all of a sudden here, I'm curious how that communication would work, given that the Fed used to argue that monetary policy works on an 18 to 24-month lag. How would you know you're not behind the curve? How do you communicate that?
So I think you've touched on a number of important questions and concerns. Obviously, one is if you were to decide that it might be best to choose a higher inflation objective? How would you go about doing that? How would you get there? We have had a hard time getting to 2%. Now, what if you were trying to get to 4? That's a difficult question, and I do not know the answer. I agree with you that I would expect interest rates to adjust, somewhat towards that, and that would have obvious implications for financial markets. So these are things that need to be thought through very carefully. With regard to our, current long-run strategy, I think, we need to do a better job of talking about what we mean by symmetry at 2% because, as I interpret this, it means that we should be averaging 2% over some time period. Now, sometimes I say, well, we've been below 2% for quite a number of years, and then I'll get the question, well, Charlie, aren't you talking about a form of price level targeting because bygones seem to matter in that calculation? And that's extremely fair. I think that there is some averaging process. Certainly going forward, there should be an expectation that we will average 2%. Now, if you're only going to be below 2%, and every time you get above 2%, you try to crunch it down, you can't average 2%. So I think we need to talk that out a little bit more. I frankly think that central bankers, as soon as inflation goes above their target, they kind of, tighten up. And even myself, when I've said, 2.5% is consistent with symmetry, and under some circumstances higher, I usually, kind of tighten up myself. So I think we have to, talk about that more. But it introduces a whole host of questions. They're difficult ones. And we're going to have to see how this plays out. And I welcome commentary from, economists, the public. There have been a number of conferences on this, and I think we need to get to a place where there's a good feeling among the largest number of people that it's a good framework. That's a tough challenge.
President Evans, thank you so much. You spent a lot of time talking about people and how they affect it and react to it. The BEA data shows that we've had decreasing prices for goods since 1995. If you take the BEA data and you pull out the high-cost cities, like Manhattan, the prices drop even more. The recent Austin Goolsbee, Pete Klenow work using Adobe Analytics data as well as the Amazon data shows there's almost no CPI increase in the last several years. So in that environment of that data, how do you then reinterpret a price level or inflation, whatever, the PCE, ex-food and energy target, given that we might not have much inflation for a long time?
Well, I mean, I'm going to, take it, pretty good value, the official indices that, the BEA and the BELS put out on these things. I recognize that there are changes in relative prices, especially goods and services, and technology is quite disruptive, so that's changed a lot of relative prices very quickly. So, I think we need to focus on our best measures, recognizing they're imperfect, on what inflation trends are for the economy as a whole. I mean, we're not going to be able to target, any particular index in Grand Rapids, which is in my territory, and things like that. Wouldn't be healthy, wouldn't be possible anyway. Now, sometimes, if I'm worried about a particular index, and is it the CPI, is it the PCE, is it the market-based prices, what about the ones that are inferred through models and things like that? At some point, I'm going to fall back on financial markets and the idea that the fixed income markets, there's an awful lot of funds and wealth at stake, and they don't want to be giving up any of their returns unnecessarily, unexpectedly. And so they're going to build in some kind of inflation compensation, some expected inflation, some compensation if inflation variability is too high. So in those cases where we somehow had a framework that generated more inflation variability, there's going to be some additional compensation, presumably, that investors are going to want. As we take our best models from finance, and again, recognize that you have to make assumptions, nothing is for free, but we try to back out what we think inflation is, inflation expectations and that, I still feel that, the numbers that come out are roughly in line with indexes that we see. So that's generally how I go about thinking about it. Athanasios is in charge here.
Hi, I'm Doug Carr. Thanks for coming and your interesting presentation. We tend to focus a lot naturally on post-crisis history, but if you look a little further back, since 1995, core PCE inflation has only been above 2% for a 4-year period which actually was the run-up to the financial crisis.
Yeah.
And as you know, not only in the US, but other major central banks are unable to reach 2% target despite pretty strenuous efforts. So isn't it time to really reconsider from the standpoint of the real economy, which is as good as you can get at 1.5%, isn't it time to reconsider whether 2% is really a valid, legitimate target? If your target were 1.5%, you'd be at or close to neutral, which based on the real economy, which is what really counts in the end, makes a lot of sense.
Yeah, that's an interesting point. I mean, I have heard that before. You know, I would say that, you know, before we had an explicit inflation objective, many people have sort of said that for a long period of time, the Fed, one way or another, kind of was aiming for about 2% inflation. You know, not officially, but people probably thought that, you know, that was a good number. So, you know, John Taylor embodies in his Taylor Rule analysis over the history of it the thought that the Fed always wanted something like 2%. That's kind of embedded in his Taylor Rule. So if you take that, then it means that we've really not been achieving that, but we've achieved less than that. I would say, as I said in the speech, I think that could be consistent with the fact that we have very conservative economists in general on central banks. Believe it or not, I include myself in that category. You can leave that to you to evaluate. And so you're very nervous about, you know, talking about inflation above 2, 3. Oh my gosh, you know, that's a big number. So if we are pursuing 2% but only delivering 1.5%, I take your proposal to be, well, throw in the towel, just target 1.5. I have no idea if we're going to get 1 because of that. Because once you set a target, I don't know if you're going to be, you know, you're going to view that as a ceiling, so we might get stuck with 1. Then we get stuck with 0.5. Now, I personally think that when we don't have enough monetary ammunition to lower the interest rate when we find ourselves coming into a downturn, then, you know, that's a problem for central banks. And so I think that if we were to adopt a lower inflation objective, we'd also have to, you know, put our arms around the idea we're going to be doing asset purchases way more often than you thought before. Now, if you like that, you got to accept that that's part of it. So these are choices. That's another framework. I said it could be a higher inflation objective, but it could be a lower one too.
Thank you for your comments, Mr. President. My question is, when forecasting your outlook for the U.S. economy, how do you personally weigh global financial conditions, particularly as measured by the monetary policies of other central banks? And if you can comment, how do you currently view those global financial conditions? Thank you.
So the role of a central banker is always to sort of understand the lay of the land, that, you know, you have to understand the state of technology, what businesses are, you know, thinking about doing, consumers. What the international sector is doing is another. How financial markets are responding is another. And so global financial conditions, you know, turn out to be an input. You sort of take it as that exogenous type, autonomous. It's not something we control. It's just like, this is the way it is. If all of a sudden there are more tariffs or, you know, a tariff response, then we'd have to take that into account, not to embrace it, but just to understand its effect. I would say that, you know, the economy is doing very well right now. Fundamentals are very strong. And a nice contributing factor to that is the fact that the global economy is just on a big upswing. I talked to executives with global business model, and I've had more than one person say, you know what, every place in the world where I do business is doing better, on the upswing, no soft spots. So that's, you know, really strong, and so that's helped propel the kind of performance like we've seen recently.
Thank you for your comments. The question is, regardless of how you define symmetry, from a inflation standpoint, price parking or whatever other version. So far, the rates have gone up from near 0 to 1.25, 1.5 range. And we have not seen much financial tightening, according to the statistics from your bank, right? So if you look at the tightening has been below 0 for an extended period of time. In fact, the more you raise rates, the lesser it tightens. seems counterintuitive. Yet, however, the two conversations doesn't seem to incongruency with each other. On the one hand, you say, well, gee, we would love to see our inflation go to 2, or near 2, or maybe even go beyond 2 to give symmetry. But on the other hand, I'm tightening as quickly as I can, within reason, because we're afraid that it's going to reach 2. So you have 1 foot on the gas and 1 foot on the brake. Part of the discussion may be to say, well, so far we have been raising rates because we're just going back to normalization. So this is a normalization discussion, not an interest rate rising discussion. And if that is indeed the case, then we really need to get a better sense of what neutral rate or R star really is. Because once you reach that, you go beyond that, then we really should be expecting what? A tightening financial condition. So I appreciate understanding how you think about that personally, and how you think the FOMC may be thinking about that, so we are better informed in understanding when rising rates are really rising rates and going to have an impact on financial condition. Thank you.
Yeah, I think you stated that case very well. This is in line with the previous question, which is, what you need to do as a central banker is have a lay of the land assessment and understand if you're, driving uphill, so you need more gas. Auto analogies are always what you do in this business, right? Or you're going downhill and you're hitting the brakes, but you're still going down because it's a really steep, downward fall. So it has been the case that as we've been raising rates, many people have sort of pointed out that, financial conditions appear to be even more accommodative than they were. So it gets you thinking about R star, where we are. The discussion about we were facing headwinds. Go back to 2011 and fiscal austerity and, clamp down on that spending. We faced a lot of headwinds during that time period. Now we've got a big tailwind, or at least the portion that comes from the fiscal side is more of a tailwind. So even if we're raising rates, it's perhaps not enough to offset that. So that's why you hear all these discussions about, we had 313,000 jobs announced this morning for last month, and that's terrific. We had a 4.1% unemployment, so that stayed constant because more people came into the workforce, and so that's a nice sign of strength too. And we saw average hourly earnings go up 1/10, which isn't all that much, but at least it's positive, that type of thing. So understanding how far along we are is very important. I always used to giggle a little bit when we started describing, well, as we raise rates, what we're going to be doing is, we're going to be increasing interest on excess reserves because we don't want the banks to go out and lend as much as they otherwise would. And you kind of go, well, it's actually a vibrant economy. We actually would like to see a lot of lending, but that is sort of the mechanism. So if real rates are going up because the economy's stronger, people are wanting to borrow more, they're willing to pay more, it's a really positive environment. And so we sort of, do we follow it up? Do we have to get ahead of that? And at the end of the day, I think the inflation data are going to be really important for this. And I think we're close to seeing it get close to 2, get to 2. The 6-month average of inflation has been 2%. I personally would like to see the most recent couple of bad numbers from last March roll off to have full confidence. But, the FOMC is clearly in a gradual funds rate increase environment, unless we see something different, weakness or strength. So we could go either way. It's two-sided.
Hi, Anne-Marie Muhlendyke.
This is always wonderful to
This is-
see former Fed people retired in such wonderful health and happy.
Well,
and-
you may not like everything I'm going to
Okay.
say, but
Well, I thought I'd
anyway.
get that out of the way first.
Having lived through professionally, as opposed to being a student, through much of the 70s inflation, I find it sort of intuitively troubling to argue for more. And part of and I'm now getting, I finally got an insight in where the difference is. When you said that you believed, I gather you believed because McCollum said it, and I'm surprised he did, that money illusion doesn't exist. That is got to be the root of why those of us who think inflation is a basically bad thing for reasons you did state but sort of walked away from, and those of us, and those of you who think a little inflation greases the wheels, that's where the difference comes from, which gets me back to money illusion. I mean, Friedman and Phelps argued that money illusion was a temporary thing and that you would get from an inflationary stimulus would initially increase output, but then as people caught on, it would back up and you would end up moving away from money illusion, and you would get the downside of the inflationary stimulus you previously got. And if you plot a Phillips curve instead of getting that beautiful shaped curve, you'd get a plate of spaghetti, which the 70s sort of look like. So when I look around in my daily life, I see money illusion all over the place. I see it in the press. I see it when I talk to people who make comparisons. Well, back then it only cost so much to do this, and now it costs a lot more, which...
Wall Street Journal says that the dollar has been degraded going back to 1913, just, yeah, no, that's right.
Yeah, and I mean, individuals...
Ignoring the fact that wages have gone up,
Yeah.
living standards, and so it's compensated for that, yes.
So I guess I'm saying, yeah, there's tons of money illusion around. It comes and goes. It's more concentrated if you live in places like Manhattan or San Francisco than if you live in Detroit, maybe, but where your housing costs are. But how can you sort of ignore that cost of inflation that you're not providing a comfortable standard?
Well, that's, that was very good. You've certainly, gotten to some of the conflicts that I think we all have personally, at least as we think about this. What I took Ben McCallum to be teaching was that, you can't fool people for very long. Not that, Ben was never one I took to be, markets are gonna, the equilibrium markets, every single period that it was gonna clear and money would never have any effect. Ben always argued that money could have an effect, that it wasn't ineffective, but it wouldn't be permanent, that the natural rate hypothesis would hold. And so you wouldn't be fooling people for any substantial period of time. We could argue over what substantial means. We could certainly bring endless anecdotes to bear on how people are not very optimal decision-making and things like that. The behavioral finance, right? Most recent Nobel Prize was granted to economist Richard Thaler because of his contributions about how people don't optimize everything exactly. But I think that in building economic models and designing monetary policy, we need to put more emphasis on the fact that it's folks who are thinking carefully about how to invest, and then they're not going to be fooled for very long about bad monetary policies, and things like that. And so that's what I was really trying to get at. And as we think about designing alternative frameworks, we need to keep this in mind. I tried to argue with my colleagues to put some things in the speech which I couldn't think carefully enough to actually include. But we go back and forth as to when we sort of say there's no money illusion and when we kind of do say. So, 4% inflation, you can hear somebody say that's never going to happen. People won't accept that. People wouldn't mind 6% nominal wage increases, though. Now, if they only got 6% each and every year and inflation got up to 10%, they'd figure that out and they wouldn't like that. But they would kind of like certain nominal, wage increases at some level. So I think it's a choice variable. I think that the true cost of inflation, steady inflation, this is very important. Steady inflation costs. It's a hypothetical, but the steady inflation costs are not nearly as high as many of us think, because we're also thinking that it's the variability. And variable inflation is very costly, but that's where the theory, the link to the theory is very imperfect, and it usually involves the central bank's just going to do a bad job.
There's already built in a lot of sunk costs and a lot of decisions that were made in the past that are still operating in the future. based upon a different world.
So thank you, Charlie. This was
Oh,
wonderful.
okay.
And
Thank
bringing
you.
up Ben again, so you can join the audience. Yeah, I wanted to say that not only answering questions, but actually giving even Ben McCallum's variants of the answers. That's just fantastic. And we're going to close with Mickey's going to have the final word.
Just thank all of you for coming. It was a great meeting. You'll hear about our next meeting. And meanwhile, all of our papers are posted on the Shadow website, shadowfed.org. And also, I want to make you aware that some of our papers and briefs appear occasionally on the E21 website. So thank all of you for coming. Good luck, and we'll be in touch with you about the next meeting.